All right, recording is started.
Wonderful. Good morning and good evening, everybody. My name is Jay Gullish. I lead USIBC's digital economy activities. We are once again pleased here today to have a legal digital roundup with some experts from Khaitan Company. For those who have not joined these sessions in the past, I encourage you to go back and see what we've done. This session will be recorded and therefore is on the record. And the layout and agenda is a nightly news format. I'm going to turn it over to our able-bodied host who will introduce the Khaitan team as we walk through the agenda of various legal, judiciary, and regulatory issues. Just so you know, we do this roughly once a month. And so if there are topics you would like for us to address in the future, do not hesitate to reach out to us. We can get them onto the agenda. In addition, if you'd like to follow up on anything you hear today, we would be more than happy to introduce you to the experts from Khaitan Company. With that, sir, I'm handing over the microphone to Paku Khan.
Jay, thank you very much, and thanks very much to the USIBC and to the audience today. Hope everybody is keeping safe. We're running this in sort of a newscast format because we're going to be covering a wide variety of topics that are seemingly disparate, and so we thought this was the best way to do it. So my partners from Khaitan Co are going to be your correspondents today, so analogize it to reporters in the field. Let's just quickly introduce the speakers from Khaitan, or KCO as we call it. I'm just going to start from the top left and then go down to the bottom. We've got Monica Srivastava, a partner in our New Delhi office who focuses on corporate law and EdTech. Sudipta Bhattacharjee, also from the New Delhi office, is our indirect tax partner. Next, we have Supratim Chakrabarti, or Supro as we affectionately call him. He's in our Kolkata office, and he is our expert on privacy. Next, we have Abhinav Chandan, who is a TMT partner, and in this case, a specific focus on healthcare data retention. In the last bottom grouping, we have Sanjay Khan Nagra, who is in our Bangalore office and our specialist on technology law issues. And then finally, Sagar Deeparati, or Sagar as we call him, who is a competition and antitrust partner from our New Delhi office. And then the fellow at the very bottom right is myself, Paku Khan. I'm actually coming to you from the Bay Area. I happen to be an antitrust lawyer myself, but today I'm going to be your moderator. So if we can go to the next slide, this is what we're planning on covering today. And as again, you can see it's a very wide-ranging scope. And what we're trying to do is give you a brief but detailed outline of some major changes. So first, Monica's going to take us through the changing regulatory landscape for EdTech in India, which is even more pronounced given the issues of the pandemic and the importance of online education. Next, we have Sudipto giving us goods and services tax update affecting the tech sector, the digital economy. We have Supro then talking about the Joint Parliamentary Committee's recommendations and amendments on the privacy bill. I'm going to cover what we call the catch-all section, and as I've used this joke before, but the New York Times prints all the news that's fit. We're going to take the Rolling Stone magazine version of all the news that fits, and we wanted to bring you just a few news items that may not have caught your attention, but we think are worthy of it. That's going to be very brief. I'll take you through that. Abhinav is going to take the health data retention policy, the new possible framework. Sanjay is going to talk about credit bureau data changes impacting fintech companies. And then finally, Sagar is going to talk about some significant antitrust issues that are pending in India involving big tech and technology generally. So let's move on to Monica to take us through EdTech and some of the changes in the regulatory landscape. Monica, over to you, please.
Thanks, Paku. Hello, everyone. In the first segment of today's digital roundup, we're covering latest legal developments in the EdTech landscape in India. EdTech has been one of the fastest growing areas in India's digital economy, especially in the last 2 years of the pandemic. And at least some part of this growth story is attributable to a fairly liberal, light touch regulatory framework. Things are changing on this front, and in today's feature, I will update you on key developments which are indicators of changing times. Before we come to that, let me take a moment to contextualize our update and lay out what the EdTech market comprises of. In India, perhaps like it is in the US, the EdTech space is highly differentiated. It comprises of K-12 tutorials, test prep for competitive examinations, continuing professional education, and formal higher education as in degrees and diplomas through online mode. The last one is where you would find the most regulation, perhaps rightly so. And the other three areas is where minimal regulation or no regulation has been the story so far, but that's quickly changing. Speaking of online higher education first, one of the most far-reaching developments in the last year was when the Indian government opened doors for formal higher education to transition to a full-fledged online format. This was achieved by rolling out an enabling regulatory framework and then swiftly following it up with issuance of approvals to eligible universities. If you take a look at the numbers, as things stand today, there are 59 Indian universities which offer more than 350 programs in the postgraduate and undergraduate category. And this is huge because at the beginning of the pandemic, this space was pretty much non-existent. I think naturally quality control in this space has been the government's key concern. And that's the reason that there are a number of conditions that every university which wants to offer online programs has to comply with. These apply at the stage of making an application or at an eligibility criteria level, but also apply on an ongoing basis. You will find these described on the left-hand column of the slide that's before you. What this means for EdTech companies is that there are more opportunities up for grabs as an increasing number of universities look to partner with EdTech players for a good LMS platform or for wider outreach. Now, the big newsworthy update for this segment, which is focused on formal higher education degrees and programs through online format, is a public notice that was issued by India's top higher education authority on 16th January. This public notice, and we can move to the next slide here. This public notice cautions against franchising arrangements between universities and EdTech partners. It requires universities to be responsible for and to own the program and the content. And it goes on to say that to the extent there are defaults, action will be taken against erring universities as well as the EdTech companies. Now, the first part of this notice, which talks about franchising, is not really surprising at all. Franchising has always been prohibited under Indian education laws because it violates the not-for-profit principle. The second part is what has caused some stir and concern, where the regulators are looking to bring EdTech companies within their scanner. So far, universities have been the ones who are on the front line and where the onus of regulatory compliance lies. But from this notice, it seems the government expects EdTech companies to shoulder this burden too. What this means is more work and direct regulatory interface, but it perhaps on the bright side also means that there will be more separating the wheat from the chaff. Moving on, I have three more regulatory updates which flow from a recent advisory issued by the Ministry of Education. Unlike my first update, this update has implications for the entire EdTech sector and not really just for the online higher education segment. First up, the government is focused on aggressive or reckless advertising practices adopted by a number of EdTech companies. So the advisory reiterates existing principles under Indian law insofar as advertising is concerned. And it reminds EdTech companies of a number of aspects. points like ensuring that students are not misled to believe that a course is official or recognized when it's not, making sure that the testimonials are substantiated and come from participants who are directly connected to the programs. There shouldn't be any false promises of learning outcomes or job prospects and the like. So that's one area of focus. Second, the government has expressed concerns on financing structures, loans, and refunds. Three market practices that the government was particularly concerned about and specifically mentioned in the advisory are areas where EdTech companies use free services to lure customers into signing up for paid subscriptions, or have auto debit and similar models where EdTech companies can unilaterally claw back or recover their subscription fees, or have complicated refund structures which can be time consuming or unclear to customers. Third, and again, this is a repetition and reiteration of the law, is that EdTech companies are required to comply with consumer protection guidelines, which are applicable to all e-commerce operators. This means no unfair trade practices, price manipulation, etc. It also means that every EdTech company must have a grievance redressal officer who's responsible for compliance and reporting and grievance redressal, etc. To sum up, the clear message and the running theme in all of these updates is that EdTech companies more than ever before will be required to evaluate their compliance status and tighten the screws wherever that's needed, and also undertake ongoing health checks for their systems and processes. Some of the work on this front has already begun. As of a few weeks back, a number of EdTech companies have come together to form a consortium and adopt a common code of conduct. The code is focused on themes that you're looking at your screen and that we touched upon in today's update. On the other end of the spectrum, there are also reports that the government has begun work on an overarching regulatory policy for the EdTech sector. So to sum up, a lot of the updates that we've discussed today seem to be the beginning of a new era of more regulation and close government watch for EdTech companies. That will be all from me. Thank you
Okay,
so much.
Monica, thank you so much. And I got just a couple of very quick follow-up questions in about 30 seconds or less, because we've got a jam-packed show here. Is the online regime that you see developing in India, the online education regime, do you think it's comparable to other countries, particularly the United States? And the second, and I notice this more and more, is the requirement of a resident grievance redressal officer in India. Just curious if you think this is a trend and if this is going to complicate things by requiring somebody to actually reside in India.
Sure. So Paku, I think just like big tech, on the edtech side of things as well, some of the problems are common across jurisdictions, and therefore regulators have turned to solutions which have been adopted elsewhere as well. I think the one thing I would add there is that unlike China, which turned to a fairly aggressive regulatory structure requiring all their edtech to comply with a not-for-profit principle, that doesn't seem to be the direction in which Indian regulators are headed, but there will certainly be commonalities and overlaps with what the US and other countries have done. So that's the answer to your first question. On the second question, grievance redressal is something that has been the law on consumer protection for a long time. And I think some of the buzz around these updates is because the government is coming out and categorically saying that edtech companies must do this too and must not seek outs on various grounds from being an e-commerce operator.
All right, Monica, thank you so much. Now we're going to switch gears a bit and get into the dreaded taxation issue. And Sudipta from our New Delhi office is going to talk about the impact of GST on tech companies.
Thanks, Aku. I think the first trend that's worth talking about is something that we are seeing increasingly, which is the increased reports of investigations, inspections that are happening against digitech companies across India and across various shapes and sizes. Under GST, there is a fair amount of power that is there with the tax officers, and they are not shying away from using it. The two or three key issues that we are seeing as a recurring theme in these investigations or enhanced scrutiny. The first one is vis-a-vis possible GST credit frauds. Now, what happens is, say a particular digitech company has a L1 or L2 level vendor on whom GST authorities have some sort of a suspicion that whether they're fake companies or tax evading companies, instead of really pursuing the investigation against those vendors, they tend to approach the digitech company exploring whether there is a wider conspiracy in terms of setting up a web of sham companies to enhance available tax credit. So that is one trend that we are seeing. The second key issue that gets raked up in these investigations is vis-a-vis uh, discounts or incentives. Now, obviously, a lot of e-commerce players, most of them, in fact, in order to retain or in order to obtain more customers, there's a huge amount of spend that happens on discounts and incentives. The question that arises is because of most of these companies from their taxable base for GST, the discount or incentive quantum is not factored in. And that is this deduction of discounts or incentives from the quantum of GST is being challenged increasingly. The third one is more of a reconciliation issue. What happens is e-commerce marketplaces in India, they are supposed to deduct or collect tax at source at 1% of all the money that flows through such marketplace. Of course, the actual supplier supplying through that marketplace is supposed to pay the actual transactional GST, and these two are supposed to reconcile. But practically what is happening, there are many issues or many scenarios of inconsistencies which have arisen for various reasons. And again, what happens typically is instead of going after the supplier, the trend is the GST authorities try to sort of look for a bigger conspiracy and are approaching the digitech companies in their, in the enhanced scrutiny sort of trend. Moving on, in terms of other GST related changes, from 1st January of this year, food delivery aggregators have been made liable to pay GST on behalf of the restaurants. There is a huge shift in terms of point of tax collection. Earlier, it was the restaurants who were liable to pay the GST. Now it is to be done by the aggregators. What that means, of course, is there is a much higher level of compliance requirements on these aggregators. And there is a concern, of course, that down the road, this will lead to enhanced litigation exposure. The second thing that has happened, again, with effect from 1st of January this year, is that passenger transportation services through auto rickshaws or electric rickshaws. Rickshaws are basically those three-wheelers that are ubiquitous on Indian roads as affordable means of public transport. Passenger transportation services through such rickshaws have been made liable to GST if they are mediated through an e-commerce platform. So if I do a street hailing of any of these rickshaws, there is no GST. But if I use the likes of a Uber app to book that, there is a GST being levied from 1st of January 22. This, interestingly, has been challenged before the Delhi High Court by Uber. And a very interesting question of tax policy is being raised. Namely, just because a service is being aggregated through an e-commerce platform, does it by itself become liable to a differential tax treatment? Like we saw in this particular case, if a street hailing does not attract GST, just because it is being aggregated through an e-commerce platform, can it be made liable for a differential tax treatment? We'll have to see what the Delhi High Court says, but this will be an interesting thing to watch out for. Moving on to the third point, this is vis-a-vis GST investigations against crypto exchanges. It may seem like sort of a subset of the first point. What has happened is in the recent months, at least 5 crypto exchanges have been raided, and $11.3 million have been recovered in back taxes. And the two key issues that seem to get pointed out every time is vis-a-vis non-payment of GST on commission income. And there are two sort of subsets to that. One is commissions for facilitating transactions by foreigners, people sitting outside India using these exchanges, and where a part of the commission is being earned in crypto itself. In both these cases, apparently there has been non-payment, and after these inspections, back taxes have been collected. While this was happening in the Union Budget 22, a whole new scheme of levy of income tax has been introduced vis-a-vis virtual digital assets, which intends to cover income tax on transfer of cryptocurrencies, NFTs, etc. But that has put a greater spotlight on the question vis-a-vis GST. What is the GST applicability on trading of these cryptocurrencies, NFTs? Are they to be treated as securities? Are they to be treated as actionable claim? Are they to be treated as intangible goods and be liable to GST accordingly? Given the sheer volume of cryptocurrency transaction that India is seeing, this is another aspect on which clarity would be required, and hopefully should come in the course of the subsequent months. That is all from my side. Thank you.
Sudipta, thank you. That's excellent. I just noticed in the slide you talk about enhanced coverage. I guess enhanced is in the eye of the beholder because it looks like it's more scrutiny and enforcement and more a wider tax coverage here. Just one very quick question for you. How is this going to work in practice in terms of record keeping and auditing? How do you think that will work out? Maybe if you can give our audience a little bit of your forethought on that.
Sure. So, GST at the end of the day is a self-assessment tax. So a lot of the responsibility for record keeping, etc., falls on us as taxpayers, on the companies as taxpayers. Having said that, there are fairly detailed record keeping requirements under GST. But when it comes to scrutiny of the nature that I just alluded to, what helps is in order to prove the substance of the transactions. So, I mean, there is one investigation that we have been handling where what came in handy was the fact that we had videographic evidence of manpower supply. I mean, so it was a case of a manpower supply vendor where we could show that these are the people who came in. This is their biometric evidence, and so there is no sham transaction happening. There is a substance in the transaction. So I think that is the nature of proof that would be required to be maintained when there is a fair amount of outsourcing or subcontracting that happens.
Thank you so much, Sudipta. And now we're going to move to what seems to be a consistently raging issue as the years go by, privacy. And so let me turn it over to Supro from Calcutta. Supro, take it away.
Thank you, Paku. And I think before this session, we spent almost about an hour in the privacy group. We have debated and deliberated on several important aspects. I would like to set the context of my presentation today, which is basically thinking about solutions now. Okay, how do we go forward? The first point which I would like to cover is basically what do we do in relation to the India-US relationship and cross-border data transfer? So in the previous session itself, we were discussing a lot of solutions, perhaps, which we could think of, like, establishment of a bilateral platform, or maybe it can go up to a larger level, quad level, etc. We could think of bilateral and again quad level data sharing arrangement, things like those. I will keep it brief there. But the other pieces that I would like to cover is, I think, is a better deep dive into certain critical elements of the bill. Now, the way the Joint Parliamentary Committee report is structured, there are two pieces. One is the report part of it, where there are certain broad brush policy level recommendations as well. And then there is a bill which has been amended and sort of put forth, for consideration. I believe that one of the strategies that could be adopted is the policy side of it, which has not gone into the bill. We could perhaps do some bit of pushback or, socializing with the relevant regulatory bodies and see that those are really measured and are not necessarily immediately legislated into the bill. One of the important ones on this is data localization. Okay, and what does the recommendation say? The recommendation says that the government should ensure that a mirror copy of the sensitive personal data or the critical personal data which is stored abroad should be brought back to India. And secondly, it states that the government should formulate a comprehensive data localization policy in consultation with sectoral regulators. Now, this is, of course, a vision that has been provided, but not necessarily has gone into the bill. I think so. We may just slice and dice and try to see that we handle this separately. Another one, which is perhaps relevant here, is social media platforms. Okay, we are all aware there is Information Technology Act and the intermediary rules. It's quite comprehensive now, and a lot of things are happening already as far as compliance is concerned. Over and above that, there has been a move to include this in the in the data protection bill. And as per the present JPC recommendation, it is saying that these social media platforms should be accountable for the content that they are hosting from unverified accounts. Now, interestingly, even this per se has not gone into the bill, and therefore perhaps a push could be on that front. Okay. The others, I would keep it very snappy. One is non-personal data. The suggestion here is we completely understand the pain point of the Joint Parliamentary Committee, but there is no sense in having a half-baked legislation where the personal data protection part is prepared and the non-personal data, we just keep an avenue open. What we should rather do perhaps is that have one single regulator. So we decide that, okay, the Data Protection Authority would be one regulator, but presently they would only regulate the personal data part of it because the law is ready. In future, when we really think through and prepare a proper law on non-personal data, perhaps that we can regulate. Right? Lastly, lastly, I think I'd like to talk about children's personal data here. I believe if you read the report, you'll understand that the JPC itself has a dilemma. Whether to sort of is 18 years the correct threshold? What we understand from discussions at various quarters that perhaps this was not deliberated at length, and there is a possibility that this could be further sort of pushed back on, and we see that the important age bracket of 13 to 16 is also brought in some manner into the bill. I will keep it, at that, considering that we are running short of time. We'll skip through the next two slides and we can then move on. Paku, back to you. We can skip these. It will be available nonetheless for everyone.
Supro, thank you so much. And let me just ask you a couple of questions, sort of basic, but pretty much all companies are covered by this, right? That have data. Is that correct?
Okay. The way the bill is structured, Paku, is that Indian entities, of course, are covered, but for foreign companies, what is really told in the bill is that if they're carrying out any business in India, if they're carrying out any systematic activity of offering goods or services to data subjects in India, and if they're profiling any data subjects, say through app or website or whatever, they would all be covered under the ambit of the bill. Now, here, there's a very important point, actually. Good that you raised the question. Business carried out in India is a very vague and nebulous term. Now, that has not been defined. So, foreign players, they have to be very careful that, and watch out, basically, how this particular definition evolves.
Okay. And one other very, very quick question. Just want to get your perspective on this whole concept of data localization. I know there have been issues in the past. How smoothly do you see the data localization requirements working in practice going forward?
No, it depends from industry to industry and player to player, Paku. But we saw from the payment systems related example where Reserve Bank of India gave a diktat that you have to localize all data. It was difficult. Of course, there are narratives from both sides, whether it is good or bad, right? There is a trade theory which says my data, my oil, I will use it the way I want. There's a security theory, which, of course, the government is playing up, saying that my law enforcement authorities are not getting ready access to the data when they want it. But we have seen that there are both sides to the coin,
Sure.
and it's not always that data localization is good. So I think we should basically take the middle path and see that maybe a softer localization, to the extent only necessary with relevant guardrails, may be looked at, because we see that this is going to come in some way, but we should have these guardrails in place.
All right, Supro, thank you so much for that. And now let me move to what I call our catch-all segment. This is news items which we think are notable. They may not be getting the coverage that they need to, and so we want to bring it to your attention. But in the interest of time, we're going to have to run through these quickly. If you need any further information on it, we put our email up there, and we'll be happy to give you our thoughts on any of these issues. So turning to the first bullet point, what we have is the Advertising Standards Council of India, or ASCI, and their recent guidelines for influencer advertising in the digital media, the guidelines as we call it. This came into effect as of June of 2021, so about 7 months ago. And they were designed to enable consumers to identify and distinguish paid promotional content content from other content posted by the influencers. So the issue is paid commentary by influencers. So last month in January, ASCII released its compliance report for the period of July to December of 2021, and it screened about 5,000 posts, stories, and feeds from influencers based on consumer complaints and AI screening. 719 of those posts were considered prima facie to be violative of the guidelines. About 80% of those posts, or around 577 of the influencers, voluntarily amended or withdrew their posts. And of the remaining complaints, 121 were upheld by ASCII's Consumer Complaints Council, and the influencers were asked to withdraw or modify their posts. So there was about an 86% compliance from the test sample that the ASCII took. And basically what we're seeing here is India's concern about the information that's being provided online. Is there something motivating that, or is that actually the influencer's own free thought? Next major point that came up is something that's just a little intriguing. Maybe there's something to this, maybe there's not. But in a previous session last year, in a previous newscast, we covered Rule 18 of the Information Technology Rules, which are the Intermediary Guidelines and Digital Media Ethics Code. And this has to do with publishers of news and current affairs content and online curated content who are required to inform the Ministry of Information and Broadcasting, or the MIB, about their entities and furnish information. As we mentioned in our earlier newscasts, this was stayed by the Bombay High Court in August of 2021, and then again by the Madras High Court a month later in September of 2021. And one would have thought that that would have sort of been the end of the road until the stay was lifted or acted upon. However, there was a Right to Information Act application that was made to the MIB, and the MIB, in its response to the RTI application, actually appeared to have called on various media organizations to disclose its compliance with Rule 18, which was, and this was in September of 2021, which was after the August 2021 Bombay High Court stay. So it's just intriguing why the MIB issued these notices, and if we get more information about that, we'll make those details available to you as they become available. Now, Sudipta had mentioned about the recent budget that came out last week on cryptocurrency, and there's a couple of things on there. The Finance Minister, Sitharaman, she announced that virtual digital assets or cryptocurrencies and non-fungible token transfers will be taxed at a flat 30% rate on any profits accrued, with a 1% tax deducted at source, and there won't be any set-offs permitted against any losses that arise from the cryptocurrency transfer while computing total income. So this is important because it's the first time that India has recognized virtual digital assets as a taxable asset class, but there's plenty of details. It is important to note that Finance Minister Sitharaman very pointedly qualified the announcement by saying that taxation does not necessarily mean cryptocurrencies are legal in India. And these measures are supposed to come into effect in April of 2022, April 1 to be exact. Very, very quickly, we've also got some activity on the drones side, or drones as a service, or DOS. As a result of the Drone Rules 2021, which went into effect in August of 2021, last week's union budget proposed the use of drones for spraying insecticides and crop assessment to help India's enormous agricultural community. This model is going to likely help the fragmented drone industry in India, and it's probably going to see a lot of startup business there as companies start working on drone measures on the agricultural side. And so we do expect to see some business opportunities. And finally, this is a little early, but there's some issues from the Reserve Bank of India on round tripping, which is basically referring to a market practice where an Indian entity invests in a foreign company, which in turn invests or already has investments in India. And the draft was open for public comment until August of 2021. So it's possible that there's going to be some easing in the round tripping rules, and we'll try to update you as that comes online. So that's it for our all the news that fits, and let's now move on to a few more of our more detailed segments. Abhinav, can you walk us through some of the key issues on health data retention and the possible new framework?
Yeah, thank you, Baku. The government recently floated a consultation paper on whether a dedicated policy is required for retention of health data. And this is not a final policy, so it raises questions rather than providing answers. But the starting assumption here is that, of course, health data is personal and sensitive data and must be protected. And actually, the genesis of this is from two interrelated cornerstones. One is, of course, the Digital India mission, which has been stressing digitization for ease of business, citizen outreach, compliance, and driving foreign investments. And even during the pandemic, digitization has been crucial in India's COVID outreach efforts, locally and globally. And as we know, digitization invites privacy concerns, which is the other cornerstone of this discussion. Supratim already spoke about the upcoming more robust data protection law, which is in the pipeline in the parliament. Now, although that upcoming law says that data retention should be for necessary periods in relation to personal data, but no specific timeline is prescribed. So this paper is seeking stakeholders' views on this specific aspect. And just for quick context, in 2017, digitization was set as a policy goal within the health sector also, which led to a blueprint for a digital health ecosystem. And the Ayushman mission was kickstarted in 2020. The larger aim of all of this is that, an individual's data, health and medical data should be accessible to the individual as well as to the healthcare entities servicing that individual seamlessly for providing enhanced healthcare and coverage. And under the system, the users are to voluntarily create health IDs for linking all their health data across platforms and healthcare entities to their ID. And those healthcare entities, which may be hospitals or labs or private practitioners or insurance providers or online pharma sellers and intermediaries, they also voluntarily register on the ecosystem, which will have a mechanism for consent management by the user for allowing visibility of specific sets of their health data. But in this process, the government will not store any data. It will be a federated architecture, where everything, all the infrastructure is to be maintained by the health entities, and the individuals may be using something like digital lockers for necessary storage. But the consultation raises a question on the need for a retention policy in the first place, posing four main questions. First is whether a common retention policy is required for health data, or should this be guided by sectoral or other specific laws or the general data protection principles, which are now encapsulated within the upcoming law. Now, to this, most of the stakeholders have commented that a more solidified policy will help in regards to data retention if the industry is moving towards digitization. The second question is who then this retention policy should apply to, in fact, meaning whether it should be all healthcare entities across the board, regardless of whether they have enrolled to the ecosystem, or only to those who have opted for it. Now, many stakeholders have said that firstly, a more concrete definition of healthcare entity itself is required, and a more concrete definition of health data as well, because different regulations provide a different definition. And they have also added that ideally any retention policy should apply to all types of healthcare entities for uniformity. However, those entities who have not opted in yet, or who do not opt in at the initial stage, say because they do not have the necessary infrastructure at that point, For them, the implementation can be in a phased manner. Third question is whether the retention period should be common for all types of health data, say 10 years for every type of health data of the individual, or should it vary for different categories like mental or sexual health data? And closely related is the fourth one, that if it is to be a category based system, then how granular it should be. Now, for both, the stakeholders have given varying views. Some suggest that the American model of categorizing under adult or minor should be sufficient, while others have endorsed a blanket period for all types of health data. The stakeholder responses also highlight a few lookout areas, which we can just quickly look at. Obviously, electronic retention. For electronic retention to work, long time storage capabilities and costs are a concern. Cybersecurity attacks and breaches are also a concern. Anonymization systems to be arranged is a concern. And using third-party service providers for digital lockers and etc. also will be a cost. Finally, the paper itself softly suggests moderately granular classification in 4 buckets. That is, inpatient, outpatient, deceased patient, data with retention period of 10 years from the last entry, while exceptional documents like medical legal documents or immunization records may be stored permanently. Now, as I said, this is all at the consultation stage, so there are more questions than answer as of now, but overall, it looks like if the policy is rolled out, it will be a step towards bringing India's privacy regime closer to global standards. Also, there might be cost and compliance implications for the entities involved. Over to you, Paku.
Abhinav, thank you so much. So I guess the title to the slide should have a question mark after new framework because it's still in the works. But let me ask you a couple of questions. Just on your slide, you talk about in section 4, proposed classification approach, exceptional documents. What might be an exceptional document?
Like you just mentioned, something like a medical legal document or an immunization record or clinical trial records or birth and death registers, those might have to be stored permanently.
Okay, got it. And then the next question is, does this consultation paper talk about who's going to regulate this proposed new scheme?
Actually, so these consultation papers, and there have been a string of them, not only on this aspect, but the entire ecosystem's functioning. All of them have been put out by the National Health Authority under the Ayushman Bharat Digital Mission. So that is going to be the overarching regulatory authority. But interestingly, this consultation paper also poses a question whether there should be a central independent body like the Data Protection Authority, which is envisaged under the Data Protection Bill. So it is a question that they have asked.
Okay. Abhinav, thank you so much. And now we're going to move to Sanjay from our Bangalore office to talk about fintech companies getting access to credit bureau credit information. Sanjay?
Thanks, Pagu. Thanks so much. Hi, everyone. Good morning. Quickly on this particular update, it's a very important one, although we will see a lot more impact of this in the coming months than just now. Just to give some background to everyone, historically, the bureau data, as we call it in general parlance, the data about credit worthiness and the points and the score loans that are taken and repaid by various people, all that data is collected by credit bureaus in India. Those are called credit information companies, CICs, and CICs are supposed to share this data only with regulated entities, with the banks and non-banking financial companies, and basically authorized and regulated entities who are in the business of lending. These are the entities who can get this data officially, and other than the user, of course. So user himself, herself can get it, or these regulated entities can get it. In this historic piece of a framework, fintechs came about a few years back, and fintechs were in a way taking this data, running their AI models on them, figuring out credit underwriting, and then giving the data back to the regulated entities for them to figure out a better way of evaluating creditworthiness and then determining on whether to give loan or not. Now, this data which was given to the fintech entities so far was done in 2 ways. One was by the registered regulated entities themselves. So banks and NBFCs, non-banking financial companies, they would give this data because they can get this data from CICs officially. And then in turn, they were giving this data to these fintech companies to run their AI models and give them the credit worthiness analysis. RBI clamped down on that and said that, look, you can't give this data which only you can use as regulated entities. You are not supposed to share this data with non-regulated entities. So that portion of it stopped. The industry practice on that stopped. What followed was the fintechs relying on user consent, because users also can go and get their data from CICs directly, and therefore they relied on user consent to get access to this data, and told the CIC that, look, we have user consent. User consents have given us permission to pull the data for them through an API from the CIC and run the AI software on that. Now that also has come under the scanner, and latest news on this is the regulation which is on the screen right now. Last November, the Reserve Bank came out with this circular and said that specified users, and this is meant to cover these fintech entities, that specified users themselves can get direct access to this data if they fulfill the eligibility criteria. And eligibility criteria was notified last month in January, where there are 7 key aspects of eligibility criteria, and 2 of them are more important than others, which make it a more limiting issue for a lot of companies. I will not get into all of them, but the more important ones are that the ownership of these companies who can get access to this data directly should be with Indian residents or Indian citizens. And secondly, they should have a track record of 3 years in dealing with such data. Now, both of these are slightly limiting factors, particularly for companies in India who are subsidiaries or majority of which is owned by foreign companies or foreign venture capital funds. And therefore, there is today, after this particular notification, sort of an issue in the Indian fintech ecosystem, where the fintech companies who are not banks, who are not non-banking financial companies, who are not regulated and don't have a license, how will they get an access to this data? There are 2 types of fintech companies in India. One, who have a platform within the group, who run the platform, online lending platform or any other fintech platform, and who also have a regulated entity within the group. For these entities, it is easier to restructure in light of this, because now they can collect data within the regulated entity if they have one within the group, and they can run their AI processes. Their tech team essentially will have to move, or some part of the tech team will have to move, and the technology itself will have to move from the fintech entity, the technology company, to the regulated entity. And the other nature of the fintech entities that exist and which are largely hit are those who do not have a regulated entity within the group. Now, for them, today there is a bit of an issue, and which is why I think it needs to be seen whether there is some other methodology that is allowed by the Reserve Bank for these second category of the fintech entities to access this data. I think I'll stop this here, and Paku, over to you.
Sanjay, thanks a lot. Let me ask you just a really high level question. Is this something that's going to be restrictive, or do you think this is going to open up new business opportunities and vistas in India?
Interesting, Paco. Every restriction brings along business opportunity. So it depends how you look at the glass, half full or half empty. I'm very sure that there are people looking at this circular today and thinking, oh, there is a problem, and how do we now solve for this problem faster than others? But I think I think at a broader level, because this also aligns with the general thinking on data that the RBI has. Look, RBI has been very vocal that payment data, this is also a form of financial data, right? So RBI has been very vocal on Indian usage of that financial / payments data, the data remaining in India, not going out. And I can see that there's an extension of that philosophy. What would be good to know is whether there will be any leeway given to foreign owned and controlled companies within India. Today, there is a blanket prohibition on foreign owned and controlled companies to get access to this data. I think they should sort of permit access to this data to foreign owned and controlled companies subject to the data remaining in India. Why should there be a disparity just because you have chosen to raise money from certain venture capital funds who happen to be in the valley, right? So I think that sort of rationalization of this should happen going forward. and I hope people don't have to create business structures around it. So yeah.
Okay, thank you so much, Sanjay. And now we're going to come to the last segment in our program on technology and competition and antitrust. This is a subject near and dear to my heart because I'm also in the competition team at KCO, and so my partner Sagar Rathi is going to walk us through some of the major tech antitrust cases going on. Sagar, just to give you a cue, we've got a little bit of time constraints, so if you can keep it to the time limit, that'd be great. Thanks.
Sure, Paku, thanks. I'm mindful of the time. I'll just go over the key highlights. While these are only investigations that have been ordered at this stage, and I'm sure this will be a space to watch out for how CCI reacts and how the investigations turn out to be. Hi, everyone. You see big names out on the screen here, Apple, Google, Amazon, favorites of any antitrust authority globally. They've seen some action, while Google seems to be a very sort of a favorite child for CCI. Apple has also joined the bandwagon, and it's also one of the latest cases and latest ones to face an investigation before the CCI. While this is not a new issue globally, Apple's been seeing activity on the in-app purchase market in the US, where it first started, and a case was brought about by Epic Games against Apple. But EU and many other jurisdictions are equally looking at this. In the Indian context, an NGO has brought about a case of abuse of dominance against Apple in relation to its policies and practices against the app developers on its app stores. Some of the key allegations are that Apple charges excessive 30% commission for the in-app purchases in comparison to the other payment processes, such as BillDesk, Razorpay, etc., which charge a much lower 1 to 5% basis the transaction value. Apple also mandates the use of its own payments processing system, which is for its in-app purchases and not for the paid apps. And the policies of Apple are quite a take it or leave it sort of a construct. And another allegation is that the app developers have marketing restrictions whereby they prevent customers from making any out of app purchases. For example, Apple prohibits its developers from informing the app users about the ability to purchase any content within the apps from on the outside the Apple Store ecosystem. So CCI has confirmed that there's a prima facie dominance of Apple in the market for app stores for iOS in India. And CCI says this is consistent with its approach that it's taken against Google on similar issues in the Google Pay and Google Play Store issues that are currently under investigation before the CCI. And in doing so, CCI has also rejected the Apple's argument that the relevant market should rather be a market for smartphones, where Apple is a negligible player in India, having a market share of anywhere between 0 to 5%. However, the CCI's take on this is that these are more traditional market definitions, and in such multi-sided markets such as tech, the CCI we like to look at more narrower definitions and similarly see how this pans out in investigations. Apple's, of course, relied on the Epic's game case, which was pretty much in its favor, but the CCI said that persuasive value, up to the extent of persuasive value, it's fine, but these are not determinative cases, and CCI will go into the facts as they are applicable to the Indian markets. Moving on, Google faces yet another investigation. There is the entity called Digital News Publishers Association, which has alleged abuse of dominance against Google. The digital news publishers basically thrive on revenue from advertisements on their pages, and they engage with Google for their search services, which really directs traffic on the news apps where in the news pages where the news publishers earn revenue from the advertisements. So there's an allegation of abuse of dominance against Google for using snippets of these news publishers' content on the search engine. Effectively, as a result of use of just the snippets on the front search page, the user's queries are generally answered on the search page itself, which basically means a zero-click search. And no consumer is not effectively directed onto the actual publisher's page, thereby incurring a loss on revenue from advertisements. And even if there's any ad revenue that the Google makes on the first page, that is not the publishers are not compensated to that extent. There's another allegation of the news publishers not being provided sufficient data on the amount of revenue that is generated by Google through the placement of advertisements on their pages. There's also a concept of AMP, which is basically tying in the accelerated mobile page format to better the search rankings. AMP is effectively a platform made by Google which loads news faster, and websites tend to use this platform for an enhanced user experience. There's also an allegation of leveraging the abuse of dominance in the markets that Google operates in because of the fact that Google has its own news aggregation services. Now, CCI has already held Google to be dominant in the online search advertising services in India. Google's faced a penalty in 2018 of about 20 odd million US dollars. And therefore, it is not difficult for CCI to come up with a market definition. And looking at the dependence that the news publishers have on the Google platform for generating revenue from the searches onto their news pages, CCI believes that this is a case fit for investigation, at least at a prima facie stage. Similar issues again, France and Australia have been seeing similar investigations against Google on similar news platform related complaints, but there's a more settlement mechanism, and I think these entities have asked Google to come up with some negotiations with the publishers and come up with the relevant advertisement fees that one could negotiate. Quickly moving on to the last piece of interesting development on the merger control side. This is the first time where CCI has actually imposed penalty on a transaction. In December 2021, CCI imposed a penalty of approximately 26.5 million USDs on Amazon for suppressing the actual scope and intent and the purpose of the combination, and also to failure to notify a certain step in this transaction. This transaction was actually approved by the CCI in 2019. Basis some information that the CCI received from parties to the transaction, it appeared that Amazon had misrepresented the scope of and the rationale behind which the transaction was entered into. As I said, first ever penalty on a merger control side on a transaction which is actually closed 2 years back. While Amazon has approached the appellate tribunal, there is no stay on the penalty, and I think this will be a space to watch out on how the tribunal looks at this. One key takeaway from this particular case is that the CCI is going forward. CCI is going to scrutinize merger transactions more closely. So from the perspective of transactions and merger filings, I think parties will need to be careful on what they disclose as the rationale. And while relevant documents have to be submitted during the course of the merger notification, CCI might also look at internal communications which really discuss the actual rationale behind transactions. That's it from my side, Prakul.
Sagar, thanks very much. And we are running short of time. So Jay, you've put out a call for questions. I know we've had some questions earlier. So over to you.
Great. I have my first question is for Monica, actually. Monica, you talked about foreign universities. What would be the impact of this new policy on foreign universities? And just to sort of make it real, would, you know, a university like George Washington University here in DC, if they were doing some online courses or something like that, would that require them to have a grievance officer in India?
Yeah. So that's interesting, Jay. The foreign universities are not covered at all in the online regulatory framework currently. I mean, that's where things stand today. And speaking of foreign universities, a big update that came as recently as 1st February when the government presented its budget is that foreign universities will finally have the opportunity to open up in India to offer courses in STEM, in fintech and financial management, and not be subject to domestic regulations. So we'll see what more comes out of this, but it's a huge development considering this has sort of been in the works for many, many years. So I think there's some reason to cheer for foreign universities looking at the Indian market.
Great. Thank you. We have a question from Nalima Pagankar from TransUnion. Nalima, over to you.
Thank you, Jay. with respect to the credit bureau data and the specified users, what's your estimate of the number of entities that the specified users will cover? What do you see as the market expansion of entities that'll be brought into this?
Many, I think almost all, each fintech in India, Nilima, today are covered within this, because every fintech, I think the main play of each fintech in India today is about data and the analysis of the data and determining creditworthiness. Although I must add that all the fintech companies build on top of the data that comes from credit information companies, because the data from these CICs is a very standard form of data, and each fintech applies its own bots and figures out other forms of social media presence, buying patterns, etc., etc. And I think all of those companies are impacted by it. A lot of those companies now have regulated entities within the group. Most large unicorns or soon to be unicorn fintechs in India have regulated entities within the group, so they are less impacted than others. But they also need to, because these fintech companies keep their tech business separate from their regulated entity business for obvious reasons. Now, if there's no change to this regulation, they will probably forced to be merging their the two of them, which I think is a bit of a concern. People who don't have regulated entities, they have a bigger issue at hand, as you can imagine.
Yeah. Thanks.
One final question that I have for Sudipta. How taxes always are an important issue to our members. How are the companies and courts reacting to some of these changes in investigations? Are they getting caught up in the courts? Are there recourse? Is there some consistency? Anything you can share in that regard, I think would be most interesting to our members.
Sure. See, I mean, courts in India, when it comes to investigations, they try to take a hands-off approach. They don't want to interfere, and unless it's really in your face, there is some abuse of power that is happening. Having said that, I think what we have seen is that high courts across India have been very prompt in terms of judicial review. Whenever they see there is abuse of power happening, interim orders are issued, are granted if a case is established. So I would say that the judiciary and the courts in India have been very proactive in terms of, and they have also been commenting on the fact that a lot of power is being given without enough checks and balances to the tax authorities. But yeah, I mean, in short, they have been quite proactive and relieved.
Great, thank you. My final question is for Abhinav. We've been spending a lot of time talking about privacy and data localization, and now you kind of shared how that impacts a particularly important sector like health. If and when the data retention policy is released, would it override any other data bill, or is it subservient to it? What's the relationship between, sector bills or policies and eventually some sort of master data or privacy bill?
So strangely, actually, if you look at the consultation paper, you will get an impression that this final retention policy that will come out will override. But interestingly, the paper says that the policy, even if it comes out, will likely not override any existing sectoral or specific retention standards that may have been prescribed. And even the stakeholders have sought clarification on this. My guess is, if another specific law or regulation prescribes a higher standard for a particular data set in terms of retention, then that higher standard might prevail over the period prescribed in the final policy.
Thank you so much. I really want to thank the KCO team. I mean, the expertise and information presented here is just really, really incredible. So I want to thank you. For our members, we will make this presentation available. We will also post the conversation on our YouTube channel. I want to thank our KCO team, and including Aloy, who's not here, but does a lot of the back end work, and Paku, who really pulls this all together. Please feel free to reach out to us. Happy to connect everyone going forward, and let us know if there are topics you'd like to have us include in future agendas. With that, Paku, I'm going to hand it over to you for the final word.
Jay, again, thank you so much. And to the audience, thank you so much for joining. Be safe. And just to reiterate what Jay said, please do let us know if there are topics that you want us to cover. We've put our email information on this screen. Just let us know and we can either cover it in an upcoming newscast or reach out to you directly. So folks, take care, be safe, and we'll talk soon. Bye.
Thank you, everyone.
Goodbye, everyone. Have a nice day and evening.